Have you ever wondered this? How did that small piece of plastic we use in our daily shopping, the thing we call a credit card, enter our lives? And where and when were credit cards, which now influence almost every aspect of our lives, first used? How does the enormous global economic system, fueled by a gigantic debt spiral created all over the world, manage to stay standing? In this video, where we will examine these and similar questions in depth, we will dive into the depths of history and explore how debt has shaped our lives throughout time. Let's begin. The debt on your credit card is actually the modern version of a 5,000-year-old debt tradition. Humans learned to borrow from one another long before they invented money. And this simple relationship, which could be summarized as "I'll give it to you today, you'll give it back tomorrow," eventually shattered kingdoms, toppled empires, triggered bloody revolutions, and shaped the modern world that now surrounds us. Now, let us embark on this mysterious journey together through history's dusty pages. As we continue this journey, if you'd like to support us, you can subscribe to our channel and like and comment on our video. Thank you in advance. Around 3000 BC in Mesopotamia, in what is today Syria and Iraq, farmers faced a major problem before planting season. Although the harvest would come months later, they had neither seeds left to plant nor bread to eat. How could they overcome this problem? The solution: borrowing from the temple. Sumerian priests would write on clay tablets, 10 sacks of grain lent, 13 sacks to be repaid at harvest. Yes, you heard that right, an annual interest rate of 33%. Even today's credit card interest rates aren't that high. The destructive effects of the debt system on society began to appear. Perhaps for this reason, in 1750 BC, Babylonian king Hammurabi addressed debt in his famous Code of Laws. He placed a cap on interest rates and wrote that indebted families would work for at most 3 years to repay their debts. Why? Because he knew uncontrolled debt could collapse society. Mesopotamian kings occasionally declared debt cancellations. It was the easiest way to prevent uprisings. As you can understand, debt had become not only an economic issue but a political one as well. For example, in 6th century BC Athens, things had gotten extremely bad. Poor farmers had borrowed so much from the rich that the wealthy had placed debt stones on their lands. This land is indebted to X. According to some accounts, those who couldn't repay their debts were even enslaved. Society was on the brink of civil war. The Athenians chose a wise mediator among them, Solon. Do you know what Solon did as soon as he arrived? He removed all the debt stones, cancelled all debts, and banned debt slavery. These reforms drove the wealthy lenders mad, but Athens survived because of them. In fact, democracy was able to emerge thanks to these reforms. There you have it, the power of debt to shape societies. After the fall of the Roman Empire, people often speak of the darkness of the Middle Ages. Yet this period witnessed fascinating economic and financial developments. During the Crusades against the Muslims, the Knights Templar faced a serious problem. Anyone traveling to Jerusalem carrying gold was robbed by bandits along the way. To solve this issue, the Templars created a clever system: deposit your gold in Paris, receive a piece of paper, and withdraw your money in Jerusalem using that paper. See? The first international money transfer system. For Muslims, charging interest was religiously forbidden. But trade and investment required capital. If a debt system involving interest couldn't be used, where would the needed money come from? The solution: partnership models. In the system called Mudaraba, the process worked like this: you provide the capital, I run the business. If there is profit, we share it. If there is loss, you lose your money and I lose my labor. Risk was shared. This system developed in that era can be considered the ancestor of today's venture capital model. In later years, in 15th century Florence, the Medici family opened a small bank. Over time, this bank became the largest financial empire in Europe. What was their secret? Branches. They had offices everywhere from London to Rome. Papal connections. They managed the church's money, similar to today's state banking. Accounting. They kept meticulous records, the foundations of modern double-entry bookkeeping. Let me give you an interesting detail. The word bank comes from the Italian word banco, table. Bankers would sit at their tables in large squares and conduct transactions. If a banker went bankrupt, his table was broken. Banco rotto, broken table, is the origin of the English word bankrupt. Over time, in the 17th century, the Dutch came up with a brilliant idea. Overseas trade was extremely risky: pirates, storms, diseases. At the same time, sending trading ships required tremendous capital. It was impossible for a single merchant to finance this alone. The solution? Create a company in which everyone could buy small shares, spreading both risk and cost. Thus, the world's first publicly traded company, the Dutch East India Company, VOC, was born. People bought shares, profits were shared, and risk was distributed. But there was a dark side. The first major financial bubble also burst here. In 1720, the South Sea Bubble in Britain and the Mississippi Company in France created enormous speculative frenzy. Everyone trampled over one another to get rich, and then inevitably the system collapsed. Do you see? This was the world's first major financial crisis. In the history of global finance, debt initially belonged to the realm of states and merchants. Until the 19th century, loans were generally given to governments and traders. Ordinary people rarely received credit. With the Industrial Revolution, this changed. Factories were being built, railways constructed, massive investments were necessary. Thus, investment banks emerged, but more importantly, mortgage loans and consumer credits became widespread. Now an ordinary family could take a bank loan to buy a house. Debt was no longer just for aristocrats and merchants, it had entered everyone's life. Paper money became common. Its value was tied to gold, making international trade and lending predictable. Thanks to the gold standard, borrowing between countries became easier. But in 1929, the Great Depression showed how dangerous uncontrolled credit growth could be. The crisis began with a stock market bubble. People rushed to the markets driven by greed. Many did so using borrowed money from banks. Banks had lent recklessly. Eventually the system collapsed, leaving massive destruction behind. People lost their savings, bankruptcies skyrocketed, and banks failed. The US responded harshly. Through regulations like the Glass-Steagall Act, banking was placed under strict control. Commercial banking and investment banking were separated. After World War II, the world decided to establish a new financial order. With the Bretton Woods system adopted in 1944, the IMF and World Bank were created. Money was no longer tied to gold, the goal to lend to countries in a controlled way, prevent crises, and stabilize economies. After the 1970s, the world changed. Banking regulations loosened, new financial products emerged, derivatives, securitization, hedge funds. The system became so complex that almost no one fully understood what was where or how it worked. When the 2008 crisis erupted, things became unmanageable. In the US, banks had given home loans to the poor, subprime, then packaged these loans and sold them as safe investments. They even resold them in derivative markets. The slightest shock would collapse the system, and that's exactly what happened. When the housing bubble burst, the system fell apart. Lehman Brothers, one of the largest financial institutions in the US, collapsed. The global economy came to the edge of the abyss. Governments spent trillions of dollars to rescue banks. The concept of too big to fail was born. If you were big enough, you wouldn't be allowed to go bankrupt. We are now in a completely new era. Cryptocurrencies, digital, non-state currencies like Bitcoin promise an alternative to the traditional banking system. DeFi, decentralized finance, loans without banks, lending without banks. Now people lend and borrow directly using smart contracts, central bank digital currencies, CBDCs. China is testing the digital yuan, Europe is working on the digital euro. Is the future of money digital? The question is, how will debt and credit function in this new world? Can banks survive? Or is an entirely new system being born? For 5,000 years, the tools have changed, from clay tablets to blockchain. But one thing has not: debt is power. Debt management keeps societies standing or brings them down. From Solon's Athens to Wall Street in 2008, the story is always the same: uncontrolled debt creates crisis. Smart regulation creates stability. The debt on your credit card today, or your mortgage, is part of a system thousands of years old. And maybe we must understand something: debt isn't bad, but if used carelessly, it is dangerous. History teaches us this: debt can build the world, and it can destroy it. Which one it becomes depends on how we use it. Thank you very much for joining us on this journey. You can like our video and subscribe to our channel to support the creation of new content. We're glad you're here.